With the banking sector under threat and an eventful week slowly drawing to a close, we have a look at what next week has in store for the markets. On the monetary front, we highlight the release of the Fed's interest rate decision on Wednesday, as well as BOE's interest rate decision on Thursday. Also, we note the interest rate decisions of SMB, CBT, and Norges Bank on Thursday, while RBA is to release the minutes of its last meeting. As for financial releases, we make a start with New Zealand's trade data for February in Tuesday's Asian session, and continue in the European session with German CEF indicators for March, while later on we get Canada's retail sales for January and CPI rates for February. On Wednesday, we get from the UK the CPI rates for February and the CBI indicators for trends in industrial orders of March, while on Thursday we note the release of the weekly US initial jobless claims figure and Eurozone's preliminary consumer confidence for March. On Friday, we note March's preliminary PMI figures for Australia, Japan, Germany, France, the Eurozone as a whole, the UK and the US, while we also note the release of Japan's CPI rates for February, UK's retail sales for February, as well as the US durable goods orders growth rates for the same month. The USD is about to end the week slightly lower against its counterparts after a turbulent week. We make a start with the end of last week as Silicon Valley Bank crashed, causing the US dollar to lose ground, a tendency which was maintained also Monday. Yet the decisive steps taken by the Fed seem to reverse market sentiment, while on Wednesday the transferring of the banking crisis to Europe, with Credit Suisse being in the epicenter, tended to provide safe haven inflows for the greenback. Nevertheless, the combination of the SVB fallout with the slowing of the headline CPI rates tended to increase the pressure on the Fed to ease its aggressive hawkish approach. The market expects the bank on Wednesday to proceed with another 25 basis points rate hike. It's characteristic of the shift in the market opinion that in the last week we were discussing the possibility of a 50 basis points rate hike. Yet market attention is expected to also fall on the forward guidance, which is to be included in the accompanying statement. Furthermore, the new dot plot is to be closely watched in order to see at which level Fed policymakers see the terminal rate landing and when. Also, the bank's projections are expected to be closely watched, especially if the bank sees the possibility of the US economy entering a recession. Last but not least, we highlight also Fed Chairman Powell's press conference later on, as he could sway the market's opinion. The pound is about to end the week slightly high against the US dollar, remains relatively unchanged against the yen, and is clearly gaining for the week against the common currency. On a more fundamental level, we would like to note the optimistic note provided by UK's Finance Minister Jeremy Hunt during the presentation of the spring budget, which was a breath of fresh air. On a macro level, we note that the UK employment data for January were better than expected, showing a relative tightness in the UK employment market, which may boost BOE's confidence. BOE, in its last meeting, hinted that the bank rate may be nearing its peak. The comment tended to inflate market expectations that the bank may be considering remaining on hold in its next meeting, yet market expectations for a 25 basis points rate hike seem to be growing. Should the bank actually proceed with a 25 basis points rate hike, we may see the pound getting some support. Also, a possible forward guidance implying that the bank has reached its terminal rate or is near, may turn an interest rate hike to a dovish hike and actually weaken the pound. Also, we highlight the release of the UK CPI rates for February on Wednesday, which could alter the bank's stance. JPY is about to end the week high against the US dollar, the euro and GBP. In a sign of broader strength for the Japanese currency, it should be noted that on a fundamental level, the reflexes of JPY's second nature as a safe haven were activated in the past week as the banking crisis in the US and Europe tended to alarm traders. Should that be the case in the coming week as well, and should market worries start easing, we may see the Japanese currency slipping and vice versa. On a monetary level, it should be noted that BOJ remained in an ultra-loose monetary policy mode, defending the correctness of the policy over the past years. Overall, the bank's dovish policy tends to be a drag for JPY, given that widening monetary policy differentials with other central banks are weighing on the Japanese currency. On a macroeconomic level, we highlight the release of Japan's CPI rates for February on Friday next week, and a possible acceleration of the rates could enhance the pressure on BOJ to at least tweak its ultra-loose monetary policy. Also, we would note the wide acceleration of the machinery orders growth rate for January, implying a greater degree of confidence on behalf of Japanese companies to actually invest in the economy, while the narrowing of the trade deficit for February tended to imply that the Japanese economy suffered less from its international trading transactions. Both releases were noted as positives for JPY. The euro ended the week low against the US dollar, but also against GBP and JPY, in a sign of a broader weakness. It should be noted that the euro was weakened on a fundamental level by the unfolding banking mini-crisis with Credit Suisse on Wednesday. On a monetary level, we note ECB's interest rate decision to hike rates by 50 basis points. Yet, the bank's interest rate decision was accompanied also by a statement on behalf of the ECB that it is ready to provide liquidity to the financial sector if and to the degree needed. Also, the rate hike was accompanied by a certain degree of uncertainty about the bank's future moves, in contrast to the February meeting, which explicitly stated that the bank planned to proceed with a 50 basis points rate hike. Thursday's forward guidance highlighted the need for the bank to preserve a data-dependent, case-by-case approach, given the relative uncertainty surrounding Eurozone's financial environment. For the time being, we note that the market seems to be timidly pricing in a 25 basis points rate hike for the bank's May meeting. On a more macroeconomic level, we note the Eurozone's industrial production growth rate for January accelerated beyond expectations, sending a positive note for economic activity in the trading bloc. Yet, in the coming week, a more decisive and fresh indication is to be released, as the preliminary PMI figures for March are due out on Friday. AUD seems about to end the week slightly high against the US dollar. On the monetary front, we note the market expectations for RBA to remain on hold seem to be weighing on the Aussie, given also the fallout of SVB. Yet Australia's central bank may be focusing mostly on the domestic data to make its decisions. We highlight the tight employment market of Australia, given the better than expected unemployment rate and employment change figure for February. On the other hand, business confidence and business conditions seem to have deteriorated a bit in February. Furthermore, Chinese data showed that industrial output growth rates for February accelerated, yet were below market expectations, while the urban investment and retail sales growth rates for the same month were also in the greens. Overall, it seems that the Chinese industrial sector got off with a good reopening and is supported also by strong internal demand, which may act as a pillar for the continuance of growth in the Chinese economy. And Aussie traders are to keep a close eye on developments, as improvement of economic activity in China could imply a greater degree of exports of Australian raw materials. Given the lack of high-impact financial releases from Australia next week, we expect fundamentals to take over, and should the market sentiment improve, we may see commodity currency AUD gaining. The CAD is about to end the week slightly stronger against the US dollar. On a macroeconomic level, we note that Canada's employment data for February were better than expected, as the employment change figure dropped, yet not as much as expected, and the employment rate managed to remain unchanged at 5%. The better than expected data in the past few days could provide support for BOC's confidence, yet any hawkish move seems to be out of the picture for the bank currently. On the contrary, the uncertainty created by the SVB fallout tends to raise some dovish concerns about a possible ripple effect on the Canadian economy, and thus is advising caution. We intend to keep a close eye on the release of Canada's CPI rates next week, and a possible slowdown of the rates, implying also an easing of inflationary pressures in the Canadian economy, may enhance voices requesting a rate cut, yet we tend to maintain a rather solid expectation for the bank to remain on hold at 4.5% in its mid-April meeting. Also, on a more fundamental level, we would like to note the wide drop of oil prices over the past few days, which may have prevented the CAD from making further gains against the USD, and should oil prices continue to drop, it may weigh on the loonie as well. As a closing comment, we note that we leave behind us a turbulent week where the markets neared the possibility of a meltdown. Yet for the time being, the worst seems to have been avoided. Nevertheless, we still consider the situation as fragile, and the possibility of a deterioration cannot be excluded. In the coming week, we may see the US dollar maintaining the initiative over other currencies in the FX market, given that the Fed's interest rate decision bears some degree of uncertainty and the stakes are still very high. Yet at certain points during the week, there are opportunities available for other currencies to shine as well, allowing for a nice blend of trading opportunities. We would like to make a small comment though, also for the interest rate decisions mentioned earlier. In Switzerland, SNB is expected by the market to hike rates again by 25 basis points, despite the recent turmoil created in the banking sector by Credit Suisse. Given the inflationary pressures have been on the rise in the land of the Alps, such a move could be understood as inflation is above target and rising, and thus a rate hike could provide further support for the Swiss franc. Further to the south, in Turkey, the Turkish Central Bank CBT is expected by a number of analysts to remain on hold at 8.5%, given that the bank had proceeded with a 50 basis points rate cut in the February meeting, and inflation, despite being at high levels of 55% year-on-year, seems to be easing over the past 4 months. Nevertheless, we would not exclude the possibility of another 50 basis points rate cut, which could weigh on the Turkish lira. Last but not least, let's not forget that at the northern tip of Europe, some analysts expect Norges Bank to remain on hold at 2.75% after consecutive hikes up until December and standing pat in January. Yet in the last meeting, the bank stated that future developments will depend on economic developments, and inflation seems to remain stubbornly high. Hence, a 25 basis points rate hike may be warranted, and Norges Bank Governor Ida Wolden-Back's comments that the policy rate will most likely be raised in March tends to highlight the scenario, which may provide some support for the NOK. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
Hello, my name is Christina, and today I will talk about GDP. Gross domestic product is the monetary value of all goods and services produced in a nation during a given time period, usually a year. Basically, it's a record of everything bought for money during the course of 1 year. Consumer purchases from a chocolate to a car and counted in the GDP. When businesses buy computers or export goods overseas, the transactions all increase the GDP. Government spending also contributes to the GDP. A related statistic is the GDP growth, which is a percentage that shows how fast the economy is growing. If the annual rate of GDP growth is 3%, that means the economy is 3% larger than it was the previous year. The rate of GDP growth changes depending on the health of the economy. During an economic downturn, the economy contracts and GDP declines. For example, the recession that lasted from 2007 to 2009 was a severe period of economic decline. A GDP figure that shows strong economic growth means that businesses are making money and can hire people. Unemployed people are more likely to find a job and consumer spending rises, leading to more profit for businesses and even more hiring. Government leaders analyze GDP reports when creating economic policy. The US Central Bank, the Federal Reserve, uses the GDP report to gauge economic activity. Investors look for signs of sustainable economic growth in the GDP report, paying close attention to the information it contains, especially corporate profits. Business leaders analyze the economy's performance as is reflected in the GDP report so they can decide on future investment and production. As a measure of the sheer size of the economy, the GDP provides economists and ordinary citizens alike with a convenient and accurate measure of economic vitality or the lack of it. Thank you for watching.
Okay, all right, guys, welcome to another IronFX exclusive webinar. So yeah, today we'll be on the TDI trading strategy. So yeah, I got to read the disclaimer first before I begin. So the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. So the material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained. So redistribution of this material is strictly prohibited. So welcome Christina, welcome Peter, welcome Ruben, welcome Didiero, welcome Steven, welcome Thomas. So where are you guys from? Where are you guys from, may I ask? Okay, you are from Germany. Wow, nice. That's a place I want to visit one day. So I haven't had the time to go to Europe yet. Oh, Netherlands. Wow, all of you guys are in the European side. So how's your trading week been? How's everyone trading week been? Any trades? Any trades taken? Namibia, where's that? Let me check it out on Google. Namibia. Oh, it's a country in Southern Africa. Nice, nice. All right. Anybody has taken any trades so far this week? Taken any sells, taken any buys? Or Christina, you have not taken any trades as you are still learning as a beginner. How long have you been trading? A few gold trades. Wow, nice. Did you buy or sell, Steven? Okay, let me load the layouts first. Oh, both. Okay, you're scalping both ways. Nice. You're against trend and with the trend. Oh, okay, still learning. What kind of trading strategies do you guys use? So by the way, if you actually have a strategy that is working well for you, please do not change your strategy just because you watch this webinar or watch another webinar teaching you a new type of trading style. Please continue using the strategy that works well for you. Oh, Christina, for 4 months you were taking trading signals but were no good. So learning now for myself. Well, it's very, very normal. So when I first started trading, it's very normal to take signals. I will not fault you guys for it. When I first started trading, I also used a lot of trading signals, even paid for premium signals on Telegram. So it's normal that traders like us start with signals, since most of the time we just want to make money. So last time I actually paid for signals, followed others trading gold, lost a lot of money. So it's part of the learning process. So once you have gotten the taking signals, trading with signals out of the way, the real learning can begin now. Okay. So let us begin. So just a quick recap. So this entire week I've taken, I think, 5 trades. So today I've taken a trade on USD CAD and USD JPY. So USD CAD, you guys can see on the 5-minute chart. So we have a high here that was just taken out, the previous high right there. So that was my original take profit target. So if you draw a line across, that was my take profit target. Take profit moving on towards the 1 minute. So price was around here earlier on. So when price went up around here, wait, let me draw things out. So I actually drew a line across. You actually see that price took out the previous low. So at this point in time, I'll write liquidity taken out. Liquidity taken due to relative equal lows. So I'm actually using smart money concepts, just showing you guys a quick recap before we can begin the topic that we are going through today. So relative equal lows, what I'm looking at, it's candles of, as mentioned, relative equal lows. So the candle was taken out, price got taken out, and then I saw that price went down, shot back up very, very strongly. So at this point, I actually thought I could take a buy already. So I entered using a Fibonacci line, drawing a fib from the bottom of here to the top. I was looking to enter on the retracement. So if you actually draw a line across, there is a nice little tiny overlap support area. Okay, let me just draw the line across. There's a nice overlap support. So this was the support line that I was looking at. Support line. I was trying to enter right there. So I took a long position there. Upon the retest, my stop loss was below the previous swing low. So all the way down, I have a relatively safe stop loss. Most of the time, price would not actually hit my stop loss. So I was actually risking 13 pips for my trade. So I was actually aiming higher, aiming higher, somewhere up on the daily chart. The take profit was higher. But because I had to do some work in office, I actually closed out my trades early. So I closed out my trade early, netted only about 8.4 pips before I closed everything out. So yeah, that's the only trade I've taken on USD CAD. So the next trade, although the risk to reward is negative, but hey, profit is profit, pips is pips. As long as we take profit, we cannot complain. So showing you guys another trade that I took just now earlier, USD JPY. So if you notice that price actually went down, you take a look at this entire swing. It swung all the way up. So obviously when you see such a big move up, you always expect a retracement back down. So what did I do? I actually draw a Fibonacci line from the bottom of this low towards the high right there. So if you draw a fib bottom to the top, then you realize that I was looking that price actually tapped into the 78.6% Fibonacci ratio. So price continue going down. So I was always looking for some kind of strong momentum like this, strong momentum pushing back up. So a strong momentum reversing back up can indicate that price has reversed, possibly indicating a shift to bullish market structure. So what happened? Price tapped into 78.6. Let me clear things out to make it cleaner for you guys to see. So tap into 78.6, price went down, and then suddenly shot back up very, very strongly. So what did I do? The moment I saw price break, I tried to enter on the next tiny overlap support area. So we have a nice little overlap support. The overlap support was listed right here. So I took a long entry, long position, entered right at that overlap support, stop loss below that recent low, also risking 13 pips, and I aimed for price to head towards the upside. So this was my final take profit target, the previous swing high. So I noticed for USD JPY, normally when price actually consolidates, if you actually notice a pattern, let me get the take profit line is not there. So if you actually notice that price went up towards the take profit target, which is the previous swing high, immediately rejected back down. That is the reason why I close my trade always at the next high. So that's a trade I've taken. So it netted me about 24 pips. So next, let me show you guys the IronFX YouTube channel. So webinars like this should be streamed and uploaded to YouTube. So it's under IronFX. Feel free to subscribe to this YouTube channel. Hey, hi there, Daihiru Dande. I think you left. Okay, I think you left. Okay, you're still here. So, hey, good morning to you. Your name is Remain an Ordinary Dahiru Dandere from Sokoto State, Nigeria. All right. So yeah, welcome to this webinar. So if you want to find out more free webinars like this, you can head on towards the IronFX website. So IronFX website, it's at this link right here. So I'll send the link to the chat. You can check the website out. So you can go under IronFX School. Okay, let me retry. IronFX School. Okay, wait. IronFX School under webinars. So it should be listed as popular. Click on it. I'll send the link over to the chat once again. You scroll down. You can actually view our educators that will teach you guys trading strategies. They are Forex instructors. So we have, okay, my image is not here yet. Okay, I haven't introduced myself. So some of you guys have already seen me before. Let me find the webinar part. Okay, so you can see here. So on this page, you can actually notice that we have the TDI trading strategy right here. So the next one, it's live trading strategy on February 23rd, which is tomorrow. So today, I'll be going through the TDI trading strategy. So without further ado, let us begin. Okay. Wait, let me clear things out. Okay. So my name is Chen Yongjing, and I'm the trade analyst for Everest Fortune Group. So Everest Fortune Group is actually the finalist for the best Forex research for 2019, 2020, and 2021. So we are also the finalists for the best equity research for 2020 and 2021. So right now we actually have a special collaboration with IronFX where we are bringing you guys the good stuff, the juicy stuff, and the best trading education that you guys can have. So next, so the first part of this webinar will be held by me. The second part of this webinar will be held by Sarah. So that's her. Later, you guys will be seeing her for the next half. I'll go through half of it. She'll go through the next half of it. Okay. So agenda. It means a few topics to cover for today. What is the Traders Dynamic Index? How does it work? The TDI trading strategy. How can we improve on the strategy? So if you guys want, you guys can actually screenshot it down. So if I'm going too fast, I'm talking too fast, or I'm talking too slow, feel free to let me know in the chat so I can slow down or speed up. So yeah, by the way, any questions you guys have, just ask in the chat immediately. As soon as you can, type it out, ask away. Because if you wait until the end of the webinar, we might not have time to actually answer you guys' questions. So what is the Traders Dynamic Index? So it's actually quite a nifty indicator. So it's actually a combination of three popular indicators all at once. Relative Strength Index, the RSI. I'm sure most of you beginner traders has already used the RSI before. So, and also the moving average, MA, I'm sure you guys have already used it, touch it, on MetaTrader 4, MetaTrader 5, when you open it, it should have the MA or the RSI. We also have something called the Bollinger Bands together with it, so made up of three indicators. So the Traders Dynamic Index is a trend following indicator. Let me write it down. Trend following indicator. So it actually helps traders to identify entry and exit points in the market. So it's actually based on the current market conditions. So the TDI consists of two lines, the red line, which is I write it down, red line, which is the TDI's signal line. We also have the green line, which is the TDI's indicator line. So this is signal. This is indicator. After I write down, you guys, please screenshot this down before I continue. So the indicator line is calculated by subtracting the RSI value from the moving average of the price. So the signal line is a smoothed version of the indicator line. So one of the main advantages of the TDI is that it can be used on any time frame and any market, whether it be stocks, forex, or commodities. The TDI is highly customizable, allowing you to adjust the sensitivity of the indicator based on your personal preference and trading styles. So the TDI can also be used to identify trends as well as overbought, oversold conditions, RSI. So when the green line crosses above the red line, let me show you. Green line crosses above the red line. Maybe there's a slide for it later on. So when the green line crosses above the red line, let me get this out. Okay, it is a bullish signal. So indicating a potential long position. So when the green line actually crosses below the red line, it is a bearish signal, indicating a potential short position. So TDI can also be used to identify divergence. So divergence, we have bullish divergence, we have bearish divergence. So later we will have some examples of the charts. We will show you guys how to make use of the TDI indicator. So the TDI also uses Bollinger Bands in its calculation by taking the difference between the upper and lower bands and plotting it on the TDI indicator line. So the calculation provides a measure of the volatility in the market, and the TDI uses this information to help identify potential entry and exit points. So let me just move on. Okay, please screenshot this down before we continue. Give me a moment. All right, so we are back. So RSI, it shows the strength, volatility of the market. It indicates if the current price is overbought or oversold. So you got to know green line is the fast, red line is the signal line. Please screenshot this down also before we continue. I'll just be going through this slide fast. We'll be going through the examples very, very soon. All right, once you guys have screenshotted it down, let's move on. So the Bollinger Bands is actually used to estimate the oscillation of the trading channel. So it looks like a rubber band. It looks like a very, very big range, a big channel that is forever moving with price. So key zones to define market reversals, 68. Anything above 68, overbought. Anything below 32 is oversold. Please screenshot this down. It's very, very important. It's a key concept to make use of the TDI indicator. All right, once you guys have screenshotted it down, let us move on. So this is how the TDI indicator looks like. You guys can actually go on to TradingView, you search TDI indicator. So when you click on it, add it to your chart, it should show as TDI-GM. So looking at the TDI indicator, we still don't know how to use it. So this is a Bollinger Band. This entire huge channel, this red channel, this green channel that is moving along, that's the Bollinger Band. So as mentioned, the green line is the fast line, the red line is the signal line. So green line is the smoothen it, is to smoothen things out. Red line is the signal line. So you can see here an example. So how does it work? How does it work? So for short term, this is for short term. I'll just highlight it out. So a buy signal. So when the green line, just take it as the green line, crosses the signal red line from below. Note this down. There's a very, very big difference. So a sell signal is when the fast green line crosses the signal red line from above. So just take note, this is a short-term trading signal. So crosses occurs very often. So stronger signals if it crosses in the overbought, oversold zone. Where's the overbought zone? At 68. Oversold zone at 32 region. Please screenshot this down before we continue because we are moving on to the live examples next. So just remember 68 overbought, 32 oversold. Or if you guys find it difficult to remember, take it as overbought as 70, oversold as 30. So you just round it up to the nearest whole number. Okay, next. Taking a look at the TDI trading strategy. How does it work? You notice that at this specific crossover right there, indicated by the blue circle, you notice that the red line has crossed the green line from below. So if you actually look up, once it crossed over, price became a buy signal. So price continued moving bullish for the short term. Okay, Peter, you are using MetaTrader 4. How can you put TDI on your screen? So you can actually download the TDI indicator. TDI indicator MT4. So it should have been on the marketplace. Okay, let me find it. Give me a moment. MT4. Okay, maybe you can download it from this website. There are many websites you can find it online. Many TDI indicators, you actually search YouTube. There's a how to add TDI indicator to MT4 or MT5. So feel free to check it out. So maybe this link, is it free? Yup, you can check that link out. Okay, so somebody actually asked a good question. Doesn't it lag behind? So definitely it does lag behind. Every indicator lags behind. If you notice, if you draw a line all the way up, the sell has already happened 1 or 2 candles behind. So in this specific situation, the red line has crossed over the green line from above, indicating a sell signal. So it's more or less lagging indicator. It feels like a MACD indicator. MACD is also lagging behind. So you notice right here, sometimes it doesn't lag behind. Notice right here, the red candle has crossed over once again above the green candle. So connecting it up here, price has started to move bullish in the short term. So next, looking at the top, you notice that price has went into the 70, above 70. Notice right here, above 70. What does it mean? Above 70 means it's overbought. So with the price above the overbought area, let me get my pen out. Overbought area, we have the red line crossing below the green line from above. So if you actually draw a line up all the way up, you notice that the crossover happened. You guys can actually take a sell for the short term. Sell until, where do we close out the trade? Sell until price starts to cross over once again. So when price crosses over crosses the red line once again, you guys can close out the trade, use it as enter and exit points. Okay, any questions so far? If you guys do not understand anything, feel free to let me know. So I'll clear the chat, erase all ink. You can actually screenshot this down. It's very, very clean now. Okay, maybe I draw a circle where the crossover happened. You guys feel free to screenshot it down. So what's the best time frame to use it? Well, you can actually use it on the 1 minute, 5 minutes, 15 minutes time frame. So personally, if you want a stronger crossover, likely you can use a larger time frame like the 1 hour time frame, because most of the time the smaller time frames such as the 5 minutes, 1 minute chart does not hold much strength. So yeah, once you guys have screenshotted it down, let me continue. So next we have the crossing of the red and orange lines. So after I explain this, screenshot it down. It's very, very important. So this is for longer term trading signal. So for buy signal, the red line crosses the orange line from below. So longer term buy. So this is a sell signal. The red line crosses the orange line from above. So there's a very, very big difference. Instead of playing around with the red line and the green line, right now we're actually using the red line and the orange line. Okay, please screenshot this down before we continue. Next, I'll be showing you examples of how the longer term trading signal actually works. Right, next, take a look now. The red line, I'm talking about the first blue circle right there. The red line crosses above the orange line from below. So right there, longer term trading signal, price actually start to move higher and higher. So what happens next? We are looking for a short, a sell signal right here. The red line crosses below the orange line from above. So it's right here, and price started to move bearish. Another example right there. The red line crosses above the orange line from below. So it's also right here, indicating that the market has turned bullish. So another one, the red line has crossed below the orange line. So it's around right here. We actually have a short. So this time frame is likely on the 15 minutes time frame, 1 hour time frame. You guys can check it out. So feel free to screenshot it down. Let me take my eraser. I'll clear this out first so it will be cleaner. Feel free to screenshot it down, before we move on. Next video. All right. Once you guys have screenshot it down, I would like to welcome my next analyst, my colleague. So her name is Sarah. I think I've shown you guys her at the start of the webinar. So this is her. She'll be coming to take over now. Okay, let me move on to this slide. Okay. She'll be taking over now. Please welcome her. Any questions you guys do not know, please feel free to ask her.
Hi everyone, my name is Sarah. So now I will taking over by my colleague Yunjin's part. Okay, so let's do the next half webinar by me. So now let's take a look at the orange line across 32, 15, and 16.8 levels. So actually, this is quite a rare long-term trading signal, because when the when the orange line across the level from below is giving us the signal that to buy, or when the orange line across the level from above is giving us the signal to sell it. Okay, maybe you guys can take a screenshot on this. So this one just is the orange line is either above or below or crossing it and to buy or to sell. But actually this is quite rare, and this one is in more longer term trading signal. It's not for like a short-term trader. Okay, so next one. Okay, so now let's take a look at an example first. So you can see when the orange line across the level level from below, you can see the orange line across the level from below. No, this you can see the point that we circle in blue is the orange line across it from above is sell. Okay, so this sell means you're entering sell here and you are looking for take profit in longer term. Okay, so means you are looking, maybe you sell here. Sorry, let me use my pen. Okay, so maybe you sell here and you are looking for take profit in the future. Okay, so this one is more for long-term investor. So let's make it clear first. This signal is for long-term investor because you see the price actually, if you sell here, is up a little bit. Okay, then bounce it, then up a little bit. Then finally it is going down. So if you are a long-term trader and you are intend to hold your trade for like maybe more than one month or like a few months, this is the signal that for you to enter it. Same as here, you can see the orange line is crossing the level. You see, this is the level. It's crossing the level here. So it giving us the word from above. So giving us the signal to sell it. So we can sell it here, and while our take profit is all the way to here. Okay, so which is another long-term sell. Because you see, actually, if you sell it here, the price actually bounces towards the resistance first, then down to the support. So same as these things, you can see the orange line is crossing the 13 level, which is this level from above. It's giving us the signal to sell it. So actually this one, you can see the price is up first. So in long term, the price will drop it, but just not as recently. So far, clear? So now let's take a look at next examples. What is all the index trading strategy? So how are we going to apply all the indicator, all the index to add on our trading strategy and to make our trading strategy more profitable? Okay, so TDI uses several classical indicators at once. So just now my colleague has mentioned, Yungjin has mentioned it, is about RSI, MI, and Bollinger Bands. So the best to use TDI is to use it within trend and support and resistance, and also stop loss. So this all the trend support and resistance is giving you a more clear of targets. When is your stop loss? Where is your stop loss? And where is your take profit? Okay, so now let's look at this example first. So just now, my Yongjin has mentioned it like which line cross which line, then giving us the signal to buy, giving us the signal to sell it. So let's look at one by one. Before you're looking at the signal first, okay, we may always draw it up all the support and resistance. As you can see, this one first support, which one is the overlap support at price of 1.08856. And the second support is at recent swing low is at 1.0311. The first resistance here is at 1.14849. So now I'm thinking about when is the correct timing that I'm entering the trade and how I'm going to, where is my position? Is there a long position or is there a short position? So let's take a look at maybe here. As you can see, maybe let's look at this point. You can see the right line is crossing the orange line from below. So it's at this place, it's giving us the signal to what? To buy it. Okay, so imagine like we buy it here, then we may put our take profit towards the first support. Okay, or like we may put it higher to the first resistance. So as you can see, it's a very nice trade if you're entering using this signal. And maybe we take another example at here. So you can see the green line is across the right from below, which giving us the signal to buy or to short. The green line across the red from below. Okay, so actually this one giving us the signal to buy it. But you can say, because the price now is at what? It's out our resistance here. So maybe we may think about it. Maybe for me, if I enter in the trade using this indicator, I may not enter in because I need to think about it. It's not at the first resistance. I feel it's a bit dangerous. So you see, when we are using the indicator combining with the resistance and support, it's more easier for us to make profit because this indicator is useful, but you cannot use it solely on the signal when you enter in the trade. Okay, so maybe we take a look at this one. So you can see this one is the orange line crossing. Sorry, there is no level. So maybe we can see the green line is across the red from below. Green line is across the red from below. So it gives me us the signal to buy it. And it's just near the first support. Okay, so maybe we think, oh, it's a very good place to buy it. So maybe my take profit may be somewhere at first resistance. And my stop loss may put at the recent swing low. Okay, so this is a very nice trick that if you're following the signal and also you're following the support and resistance. So there are a lot of cross and different people seeing the graph in different ways. I cannot like show you guys all the cross. So maybe I will try to demo more on different thing, or maybe we can see this one. When you see the right orange line is crossing the level, you see the orange line is crossing this level, is crossing 15 level. So actually for the indicator, it give me us the signal to the orange line crossing the 15 level, crossing the 15 level from below. So it's giving us the signal to buy. So which means we can enter in the trade here, okay? So maybe our take profit will put towards the first resistance and our stop loss will just put it at first support. Okay, so let's go to next example. Okay, here is another example. Same thing. Let's find out the first resistance, first support, or like second resistance, second support. Because this one, I want to give you guys a more clear explanation. So that's why I just using one resistance and support. So you can see here. The orange line, sorry, it's not orange line, it's the red line crossing the orange line from below. Okay, you can see here. It's giving us the signal to buy it. So we can buy from here and take profit towards the first resistance. Or we may also see this one as a green line across the red from below. Okay, green line across the red from below. It's also giving us the signal to buy. Okay, so you can see actually all indicators sometimes just add more confluence to our buyers, whether we should long it or short it. So let's take a look at this one. So the red line, so the green line across the red line from below. So actually this one giving us the signal to what? To buy it. But let's take a look at the graph chart here. So actually here at the price is somewhere this level. So for me, I feel a little bit insecure because it's in between the first resistance and first support. I need a further signal to give me. If I then means I cannot only rely on this signal. So I will not enter in the trade here. As I will say, okay, if I really enter in the trade for buy, then I lose it. I lose the trade. Or maybe we take an example as maybe we take the example as this one. So orange across the level below, orange line across the 30, this one I think is 39 level. So it's giving us a signal to what? To buy it, right? So maybe we can buy from here and our take profit is towards the first resistance, but actually it did not hit the first resistance. So these are all the signals that give me and whether I should enter in the trade, how I'm entering the trade. Should I long it? Should I short it? Okay, so now let's talking about how to improving on the strategy. Means how are we going to combining with all the indicators to improving our strategy? So firstly, we can use the index with Fibonacci retracement. So we can use all these index together with Fibonacci retracement or first support and second support. First support and first resistance to see is that the correct level or is that the best level for us to enter in the trade. So imagine take this as an example. We can see here the green line. No, sorry, it's here. The green line is crossing the red line from the green line is crossing the red line from below. So imagine we take a look at this one. The green line is crossing the red line from below, which gives us the signal to what? To buy. Okay, so now I take a look at this graph here. So now I take a look at graph here because the price is on the first resistance So it should not, okay? So I feel I should not enter in the trade. I may wait for further signal to enter in it. Now let's take a look at another examples. Okay, so it's how are we doing it with divergence? So there are different kind of divergence. So here you can see it's very regular bullish divergence. So means bullish divergence means in this shape. So when you use a trading system that anticipating a market move, chances that you may not be wrong or right, but you cannot be right at all the time. As you know, the market is irrational. Therefore, there are times when you right on the money, but there are many times that you need to prove, there are also times it's wrong. Okay, so this is a very regular bullish divergence. And if you're following this, okay, so if you're following this trend, okay, actually this price maybe go up because it's on a bullish divergence. And same for here. This one is a bearish divergence. So a regular bearish divergence is the line we draw it on top of the candlestick, and the line we draw it on top of the red line. Okay, we only draw the divergence by the red line, means we follow this shape. Why we only draw this one? Because the other two other three lines is very smooth. So now let's take a look at TDI with Ichimoku cloud. So Ichimoku cloud is another indicator for us to identify is that a bullish or bearish market. So let's just do a quick recap. When the price moving below the cloud, something like this, you see this is a price movement and this is a cloud. So means what? This is a bearish market. So when the price, imagine, is moving here, so it's a bullish market. Okay, so because we are using all the cross together with Ichimoku, that's why it can give us a better signal for us whether it's a bullish or bearish. Should we enter in the trade? Okay, so let's just take a quick examples. So maybe let's take a look at this one. The green line. Okay, so even though the price now is below Ichimoku, okay, you can see some is within Ichimoku. But if I really want to anticipate the market, or I really want to enter in the trade, you can see here, the green line is crossing the red line from below, so giving us the indicator to buy. Okay, so you can see here, even though the price is below Ichimoku, but I still can take a little profit towards a price of 1660. Okay, oh, we may also look at here. The green line. Okay, so now let's look at here. So the green line is crossing the red line from below. So actually this one giving us the signal to buy it, right? But now I feel, okay, so it's at here, okay, the price is within Ichimoku. So I don't like to trade when the price within Ichimoku. So I may just wait it, but I may just hold it until further signal for me. So that is how we are using Ichimoku, okay, to help us to enter in the trade. It's like sometimes it's very good for us to enter in the trade. It's at more confluence. Sometimes it's No, I mean the Ichimoku cloud maybe show you to short it, but the signal for you is to buy it. So maybe you should hold it until further signal. Okay, so now I may end today's webinar and thank you for your attending. Thank you, everyone.